Hello, Matthew Copley here with Copley Financial Group and here with another market update. Today we're going to cover a lot of topics, specifically this post-Charles Schwab conversion, an update on what's going on. We're also going to cover inflation, what the official numbers are and what to look out for going forward. And we're also going to cover specific recession indicators. And some of you have asked for, Matt, I know you're saying that there's some bad recession indicators out there. What are they? So I'm going to go into some specifics on exactly what those indicators are. Quick update on the Charles Schwab conversion, some of the things we're looking at. First, I want to point out that the last TD Ameritrade statement, which is September the 1st, actually shows the value of everyone's account at the end of market close on September 1st. Unfortunately, the first Charles Schwab statement shows the end of market close on September the 5th. So that means that all of the performance of the investment accounts between September 1st and September 5th is missing. So some of you have noticed that your accounts are down a little bit, and the last day of TD Ameritrade and the first day of Charles Schwab does not match. Well, I promise you, you have not lost any money in those accounts. It's simply the days that they're showing. They're showing the end of market close on September 1st at TD Ameritrade and the end of the day market close on September 5th for Charles Schwab. So keep that in mind when looking at those statements and what the differences is. I promise no one has lost any money in those accounts. Some other things we're noticing with the Charles Schwab is that if you don't log in to your account within 6 months online, you will automatically be reverted to paper statements. So if you want to make sure you stay on the email statements and the electronic, you need to make sure you log into your new Charles Schwab account to make that happen. Some other things is we're seeing a lot of problems with Charles Schwab, and a lot of this is just getting used to working with him. A lot of things, I'm not sure if Schwab was quite ready for the merger with TD Ameritrade, so we're kind of fixing a lot of problems on our end. We're addressing all those. If you have a problem, please reach out to us and let us know. We want to address any issues. Some of the things that have come up for us is some of the documents that we could do DocuSign with TD Ameritrade are now back to paper documents with wet signatures. Feels like we're going backwards in time. So we're doing our best to get those up to speed and maybe have Schwab get those up to today's technology. Some other things that we're watching is the tax withholding and the distributions. With TD Ameritrade, it's very simple for us to do this. With Charles Schwab, it is a lot more difficult. They're taking 3 to 7 days to set up tax withholding and then another 3 to 7 days to process distributions. So it's very important that we get the tax withholdings and the distribution information, the void checks on where the money goes up front. If you request a distribution and we don't have a lot of that done, we do have a very simple step-by-step action that you can take, and we can provide this to you. We can email you instructions where you can go on your Schwab account, set up your tax withholding, set up all your distributions ahead of time so we can immediately process the withdrawal. So it's a little different than how we were handling it with TD Ameritrade. We're going to overcome this. And at the end of the day, some of these adjustments we're getting used to. We're doing everything we can to try to get through this and make Charles Schwab get up to speed on some of the stuff we were able to do with TD Ameritrade. And if they can't perform, we'll simply find another custodian to use. They're not the only custodian out there. So we'll look for other companies that maybe offer better service, and we'll keep you posted. You might have an option working with us in the future where you can choose to stay with Schwab, or here's a new company that seems to be working better. So we'll keep you posted on any changes on that front. The next thing I want to talk about is inflation. We got the official inflation rate, and we know exactly what everyone's Social Security checks and pensions that are tied to inflation. We know what the increase is going to be in 2024. That increase is going to be 3.2%. Now, before you say, wait a minute, inflation's a lot higher than that, I want you to understand this is the official data. There's a lot of accounting tricks and things that the government does to make this number look smaller than it is. In fact, there's some great videos out there that have been produced that I've watched recently where people are going into Costco and they actually videoed specific items and what the cost was 1 year ago, and now they've done the same thing today and compared the prices. And of course, prices are up substantially more than 3.2%. At the end of the day, inflation is a very big deal. And I've said said this for years, that inflation is the single biggest threat to your retirement. At the end of the day, they're not going to give you as high of an increase on your Social Security and pensions and other things to keep up with the rising price of food and energy and all the things that we have in our daily life. So inflation is such an important topic. I'm actually going to produce an in-depth video. It's probably going to be in multiple parts where I talk specifically about inflation, the history of inflation, who benefits, who's hurt, and how it affects your retirement. The next thing I want to discuss is recession indicators. Some of you have asked, Matt, you think a recession is coming? What are you looking at? I'm going to go over specific indicators on exactly what we're looking at, why we think a recession is coming. And also, I want you to understand, just because we're going to have a recession, it doesn't necessarily mean that all stocks are going to go down. In fact, even in 2008, the biggest crash we've had since the Great Depression, not all stocks went down. In fact, there was one stock who went up quite a bit during 2008, and that stock was General Mills. Well, they make Cheerios. They produce things that we need in an economy. So you have to remember, people need to eat. They need to put gas in their car, but they don't necessarily need to upgrade to the iPhone 15. So you got to understand there's some good stocks out there for recessions. Furthermore, at this time, it's different than 2008. We're seeing inflation. In 2008, we didn't have these inflation indicators, and I need you to understand inflation causes prices to go up on everything from consumer goods to assets, so we have to look out for that. And our primary goal in working with us is to protect your principal. In fact, sometimes people call and they say, Matt, you're not outperforming the stock market this year in 2023. What's going on? We're not trying to outperform the stock market. What we're trying to do is outperform the stock market on the way down. And you'll notice in 2022, when the stock market was down 18%, our client accounts were not down. They were down 6-7% at the most. We did not see big major drops like we did in the market in 2022, and so we didn't have as much to recover in 2023. If you compare performance from January 1st, 2022 all the way through today, in fact, the last 2 years, we've really outperformed a lot of the indexes and benchmarks. So you have to look at this from the standpoint that our first and primary goal is to protect your principal. Most of our clients are in retirement or they're getting close to retirement. They don't want to lose principal. So let's talk about the actual recession indicators that we're looking at to see whether or not we're going to have a recession. The first thing that everyone looks at with recession is jobs. How is the jobs market? And the recent BLS report said jobs went up over 300,000. So this is a good report. But if you look inside the data, it is a horrible report. In fact, that data, I have questions about the data. If you look at the ADP report, it tells a much different story than the BLS report. But that said, if you look inside that actual official BLS report, we're seeing over 800,000 full-time jobs being lost. And in exchange, we have 1.1 million part-time jobs being added. So when you have 800,000 full-time lost and 1.1 part-time added, that's a net 300,000 job gain. But this is a problem. 800,000 full-time jobs lost in 1 month, that is a massive, massive loss. And where are they getting all these part-time jobs from? I don't know. The data isn't telling me that these part-time jobs even exist. And so I have a lot of questions about this data. The other thing is the inverted yield curve. This is something that really shows when a recession is going to start. And an inverted yield curve is when short-term interest rates are paying a higher rate than long-term interest rates. So for example, if you invest money for a short duration, maybe in a money market or a 1-year CD, you will get a higher rate of return than if you invest for 3 years or 5 years. And the reason is the market believes that we're going into a recession. So they would rather lock in these interest rates for a longer period of time, even if the guaranteed rate is lower, because they're worried that these short-term high rates will not last. Now, we also understand that when this happens, inverted yield curve, there is typically a time frame that a recession begins. If we look at historical data, that puts the time frame for when a recession is going to start between December of 2023 and June of 2024. So understanding that data, it tells us that the yield curve says we're going to be in a recession sometime at the beginning of next year. Other indicators that we're watching is consumer sentiment. There's a survey that's done that is put out, and the consumers determine whether or not they feel like the economy is doing well. And right now, that sentiment survey is actually in decline. People are worried about the economy. They're worried about what's going on. And when consumer sentiment data drops, it tells us that a recession may be imminent. The other thing that we can look at for consumers is the spending. So consumer spending is way down. And we can look at credit card data to determine how much consumer spending is being done. And of course, the September data was horrible. It was down 10.8% year over year. This is a really bad number for consumer spending. So if we look at consumer spending at 10.8 down, this is horrible. Well, let's look at the weekly data, which we have. The first week of October, we actually have data says that consumer spending is down 11.9% year over year. That means the October number is not starting out very well, and it could be an all-time record low in consumer spending. This is a recessionary indicator. When consumers stop spending, the economy slows down. The other thing that is a huge indicator for recession is corporate bankruptcies. This is something that we're seeing. Corporate bankruptcies are really in a bad spot. In fact, whenever corporate bankruptcies spike, this usually tells us that we are entering a recession or we are in a recession. The last time corporate bankruptcies were this high was during the 2020 COVID crash. And the last time it was this high before that was during the 2008 crash. We currently now have 8 companies per week that are filing for corporate bankruptcy. And these are only companies, they only recognize companies that have over $50 million in debt that they are claiming bankruptcy on. This is a very bad indicator for the economy. Another recession indicator that we like to look at is manufacturing data. So we have these PMI reports that are put out all over the world on how manufacturing is doing, and almost every single one of them is flat or in contraction. This includes the United States, it includes the Eurozone, it includes Asia. In fact, China is really hurting. We're seeing a lot of horrible data, bankruptcies out of China, unemployment of the youth. In fact, the Chinese government has stopped reporting unemployment among the youth because it's so bad. So if you look at the manufacturing data, it tells us that less things are being produced in the world. And this actually goes into what we see in the economic numbers. Commercial industrial loans are in contraction. Now, this usually happens when we're already in a recession. We start to see a credit tightening among the banks. Commercial industrial loans are now at the point where it says we are already in a recession. Now, that may mean that we're about to enter a recession, but this is a leading indicator that tells us when a recession is already in place. Now, another thing that we're watching with this manufacturing data is small business optimism. Small businesses make up a huge part of the economy, and there's a survey that's done to small businesses that asks them how they're doing. And of course, this is a real dismal survey. In fact, small business owners are reporting that their business is really under pressure, and the number one cause that they're talking about is inflation. Inflation is causing wholesale prices to go up. And also, they're having to pay employees a lot more money. And this is true across the board. You've probably seen a lot of the media talking about unions that are pushing employers to pay the employees more money. And this is something they need. Prices of food and energy is going up, so they're pushing to get their employees a higher wage. And this is true for small businesses across the country as well. Even the ones that are non-union, they're having to give their employees more money in order to keep them and keep up with inflation. This also brings up the IMF projections for inflation. And they just announced that they believe that in 2024, inflation is going to be 5.8% worldwide. Now, this is a big problem when inflation is this high, when we're seeing prices around the world go up on food, energy, and one of the big things we're watching is oil. Oil prices are starting to rise again. Obviously, this has a lot to do with the geopolitical events on what's going on in the Middle East. This is very negative for the economy. Now, obviously, my heart goes out to all the people that are affected in the Middle East by what's going on. But at the end of the day, I like to see the economic result of what this is causing, and that result is going to be inflation. Whenever you have a lot of war causes inflation. It causes food prices to go up. It causes oil prices to go up. And unfortunately, energy is a major component of our everyday lives. It's also a major component when countries are making war. So when energy prices go up, this is going to affect all of us. It's going to affect the prices that we're paying on everything, not just the price of gasoline that you put in your car, but it affects the prices on everything, because almost all of the goods that you buy, they're being shipped either by a boat or a plane or a semi-truck. All of that takes energy to move that stuff around the world. And if energy prices go up, prices for everything go up. Let's talk about what we're doing for our clients, what we're doing for you, and what you should be doing. If you're not a financial client, here's what we should be looking out for to help protect you with what's going on in the world today. Number one, you want to take advantage of these high interest rates for as long as possible. It's kind of like when interest rates drop really low, you want to refinance your house at those low rates for as long as possible. And so now we want to lock in these higher rates for as long as possible. And so one example is we can put money away right now for 3 years at 5.25% per year. Guaranteed, no fees, can't lose, 5.25% every year for the next 3 years. However, if you put your money away for 5 years, you're only going to get 5.22%, not 5.25%. So when we compare those numbers, you're actually going to get paid slightly less interest on a 5-year. Now, why would someone do that? I actually personally recommend right now the 5-year. And the reason is you're getting guaranteed interest every year for 5 years. If interest rates go down because of a recession, and this is highly likely, we're seeing the government run massive deficits. We're already seeing the government spend more expenses on interest than they do on the national defense. These are huge numbers. So interest rates are most likely going to go down. So one of the things you can do to help protect yourself from a coming recession is to lock in part of your money at the highest rate possible. Right now we have a 5.22% rate available every year for 5 years. That particular investment account also offers a 10% annual withdrawal. So you can get at some of the money every year during the 5 years. And at the end of the day, this is a smart move. Another way that you can protect your accounts is using the buffered index portfolios. And we've recommended these. These have been our top performers for the last couple years. This is where you can invest money in the stock market. And we have a new one that's coming out on November the 10th, a really, really nice one. This one's on the Dow Jones. And what it says is it's a 2-year investment. If the stock market goes up anywhere from 0 to 27%, you get the whole thing. If the market goes up 20, you get 20. If it goes up 27, you get 27. But we're going to agree to give up everything above 27% over those 2 years. So if the market's up 35% or 40%, you're only going to be up 27%. Well, in exchange for giving up everything above 27, we're able to buy 2 insurance policies. The first one is a 20% inverse return, which means if the stock market goes down 10%, not only do you not lose any money, you make 10%. So we're betting that the stock market goes down. This happens all the way to 20%. So if the market was down 19%, you would not lose a penny. You'd actually make 19%. That's a huge differential. Now, the second insurance policy is simply a reimbursement. If the stock market was down 25%, you would get reimbursed for 20% of your loss. You still would be down 5%. So this is a way that you can hedge against risk. I think the likelihood of the stock market going down more than 20% over a 2-year period is very, very low. In fact, those kind of scenarios, I would think the government would come in with massive stimulus, drive inflation up. And I actually think inflation is going to be a lot worse than they're telling us in 2024. So I think the downside risk is pretty low, and the ability to get a 27% gain on the upside is fantastic. So that is available right now. Some other things we want to look at, of course, is to make sure that we're protecting you from inflation. And this is very simple. We put the money in company stocks that do well in an inflationary environment. This includes food production. It includes energy production. It includes commodities like lumber and metals and precious metals and these kind of things that go up when inflation is worse than they're telling us. And with war going on in the Middle East, I can almost assure you that inflation is going to be worse. And so very, very important we take a look at that. We're doing this every day for our clients. We're doing this for you. If you want us to take a second look specifically on your accounts, feel free to reach out to our financial advisors. We're more than happy to help you and discuss any of these things with you. Also, just some quick housekeeping at the very end here. I want to make sure that everyone's getting prepared for Roth IRA conversions and required minimum distributions. These are things that we have to do by the end of the year. So if you are age 73 or greater, you do have to draw money out of qualified retirement accounts. We're going to do those calculations for you, but it has to be done by the end of the year. You have to request this. We're going to tell you what the numbers are. We'll email you, but at the end of the day, you have to tell us. You do have to sign a form to draw this money out. Also, I'm a little concerned about Charles Schwab and some of the transition, so let's get this done sooner rather than later. Also on the Roth conversion side, we have until the end of the year, but they are recommending that we get this done by the beginning of November, that all these conversions are in place. So if you do want to move money from IRA to Roth, pay the tax, we can certainly do that. And of course, we have fantastic strategies now for some of our clients where we can actually put money aside and do a valuation discount, where we're able to move money from an IRA to a Roth at a discounted value. Now, those are only available, those investments are specific to accredited investors. These are people that have $1 million or more in assets, in investments. And so if you're in that category, definitely reach out to us. We want to talk to you about this valuation discount. I think it's a great, great opportunity for a lot of you. So with that said, I hope that was a good market update, and feel free to reach out to us. We're happy to help, and I hope to see you in our Mission Valley office very soon.